Okay, this is problem 4. On January 1st of 2014, Pontiac acquired an 80% interest in the common stock of Stark Company for $400,000. Stark had the following balance sheet the date of acquisition. So this is January 1st of 2014. And I already copied it on over here, so that's already done. All right. The buildings have a 20-year life are undervalued by $80,000. So this needs to go up. This should be $280,000. And equipment is undervalued by $50,000. So this should be $110,000. I went ahead and put the original numbers in to save some video time. All right, Stark issued $100,000 of 8% 10-year bonds for $96,719 on January 1st of 2011. Annual interest is paid on December 31st. Pontiac purchased the bonds January 5th of 2015 for $104,770. Both companies use the straight line method to amortize premium or discounts. Okay, so let's see. The building had a life of 20 years, and the equipment has a life of 5. All right, so we paid $400,000 for 80%. It's just a basic, straightforward one. So the 400 divided by 0.8. Now, I'm not going to lie, this problem is a little long. It kind of does everything through bonds. All right, fair value of net assets is going to be the 485 minus the sum of these liabilities. So we have 500 minus 345, and here's our goodwill. And I don't really do that bottom part. Okay. All right, so this is going to be the 500, 400, and the 100 to the NCI. Common stock, 10, 90, and 115. And remember, this is back on January 1st of 2014. All right, when they purchased the company. So 500 minus 215, that is our excess. And I can just copy this stuff on over. Alright, so this was a building, and it was 80,000 adjustment. The equipment was 50, and then we had goodwill. That was 155. And hopefully that will equal 285. And it does. Yay. Alright, so then we have a little schedule here, amortization schedule. This goes along with these adjustments right here. Alright, so this goes with this. All right, so we have the building, equipment. Building has a 20-year life. Equipment has a 5. Annual amortization is the $80,000 divided by 20, and the 50 divided by 5. All right, and that's what it is in the current year. Okay, so we bought them on January 1st of 2014. All right, 2014 has gone by, and we're doing the end of 2015. So we would have done this in 2014 as well. So our prior years is 4,000. This should be 10, sorry. And 10,000. So at the moment, a total of 8 for the building and 20 for the equipment. Will have been recognized. Oh, dude. Just copy it. Thank you. All right, we're going to use that when we do our elimination entries. All right, so then they tell us down here. On January 1st of 2015, Stack held merchandise acquired from Pontiac for $15,000. So there was $15,000 in the beginning inventory. During the 2015, Pontiac sold $50,000 worth of merchandise to Stark. Stark still held 20 of this at December 31st. All right. Pontiac has a gross profit rate of 30%. So multiply that out, and we're going to have some entries for that. All right. I also want to figure out the loss on these bonds. I don't quite want to do this yet, but I'm going to figure out the loss. I think I kind of do it a little different way than they do. It still works out, but that's okay. All right. So the bonds were originally sold for $96,719 on January 1st of 2011. So we want to test that. All right, I'll move this down one. Their face value is $100,000. So they sold for a discount of $32.81 initially. All right, and that was at January 1st of 2011. All right, then they were 10-year bonds. So they're amortizing. If you divide that, they're amortizing that much per year. All right, it is now January 1st of 2015. So 2011, 2012, 2013, 2014. 4 years have gone by. So multiply that. That's the amount of discount amortized. All right, so 96,719 plus the 1312. This is book value at 1/1/2015. Okay, so then Pontiac paid $104,770. Book value, or carrying value, whatever you want to call it, is $98,031. And if you subtract the cash paid minus the carrying value or book value, you get $67.39, and it's a loss. Okay, so that's how I do my loss. And we'll come back and do this here in a minute. All right, so up here, we've got this sub. We need to do the income distribution. All right, so their internally generated income. I gotta go down here for that. Here's my trial balance. Let me make this big. Okay, so let's just go over here and do sub-income. Sub-income. All right, it's going to be the sales of $220. Minus cost of goods sold. Minus depreciation expense. Minus depreciation expense. Minus other expenses. And minus interest expense. That is way off. 10, 10. Oh, because this is 10. Okay, that looks more correct. Okay, so that's the sub-income. Internal. This is internal. Let's do the parent, Pontiac. So that one is 600,000 minus 410 minus 30 minus 15 minus 109,360 plus 7205. Okay, and that's the parents' internal income. Notice I did not count their share of the subs. I only counted the stuff they made on their own. All right, so 24,672. All right, so subs internal is 24,672. All right, they have to absorb this loss on bond retirement. Because remember, you assume that the bonds are being retired. All right, and they also pick up or have to eat the building and the equipment depreciation. That was 4,000 and 10,000. And that is this right here. And they're also going to have, I guess I should do this thing up here. Where is it? Where's the bond schedule? Okay, so the investment in bonds is 103,975. carrying value is 98,359. All right, that's at the end of 2015. So they've done another year. Here, all this that I did right here was at the beginning of 2015. So what they've done at end of 2015, there would be the 98,031 plus another 328 that's been amortized of the discount. So that's where that 98,359 comes from. All right, and notice this is right here. And then this is these two. $100,000 minus the 1641. All right, so you take the difference there. Okay. All right, then the interest expense. Well, actually, it's right down here. You don't need to calculate it. It's down here. You've got interest expense of $83.28. And then the interest income or revenue of $72.05. All right, subtract those two. And then when you add these up, they equal the loss. Fancy that. I guess that should be, here, let me move this up one. All right, so this 1123 though, the reason I went ahead and did that is that 1123, my expense limit was 83.28, my revenue limit is 72.05, and I get to add that 1123 back to the subs. Internally generated income. Okay, so that is it. Draw like a line underneath it. And then it's these two minus these three. All right, the NCI gets 20%, and the controlling share is the difference. All right, so the internally generated, let's see, the controlling share is the 4045. The internal generated is the 42,845. All right, and then they have the inventories. So the ending inventory was 6,000, and that comes out. Where am I? That's going to be on the debit side. And my beginning inventory, I'm releasing the profits. With the ending, I'm taking the profits out. With the beginning, I'm releasing the profits. And it was 45, right? Yeah. So I'm going to add them up. It's going to be over here on the credit side. Plus minus the debit. Okay. those two numbers are from here. All right, I think we can start our eliminations now. We're 20 minutes in. So you know what? I'm going to leave that. I'm going to stop this video and I'm going to do a second video for the eliminations.